A very good afternoon. Welcome to Your Stocks in the Mumbai News Studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a day where we're seeing some amount of consolidation on the screen with a negative bias, you'd have to say. So currently we have the Nifty, which is down around 69 odd points, and the Bank Nifty, which is absolutely flat at this point. The mid-cap index also trading with a cut of around over 100 odd points. We do have a lot of cues lined up in the next couple of days, especially from the earnings space. So that's probably going to be top of mind in terms of what the markets are probably bracing themselves for. We have the likes of Bajaj Auto, which will be releasing numbers today, Infosys tomorrow, Axis Bank tomorrow. So a lot of cues in terms of earnings. Hi, Vinny.
Hi, good afternoon, Ekta. And yes, a lot of cues that we're keeping an eye out on. And today what's interesting is that the Nifty, Auto and IT, both of them are severely under pressure. Both of them among the top losers. So yes, because the auto names, whether you look at an M&M, that's under pressure today. And in the IT side, we do have Infosys, TCS. That's also a bit under pressure. So let's keep an eye out on earnings because those are going to be the important cues that we're keeping an eye on now, starting obviously this week and going on for a month. But let's get started with all your stock-related queries. And to solve all your queries and doubts, today we have our experts. We have Rajat Bose joining in with us, as well as Sharad Avasthi joining in with us this afternoon. Good afternoon, gentlemen, and thank you so much for joining in with us on the show. Rajat, I want to start with you and just let's talk about the markets, right? Last couple of days, we've seen that subduedness creep into the market. What are you watching out for in terms of the Nifty 50 as well as the Nifty Bank? What are we watching out there in terms of levels?
Good afternoon and thank you for having me. What I would like to say about the Nifty is that Nifty currently in a range-bound situation. Immediately, it needs to take out 25,050 to about 25,100. If it manages to do that and sustains above 25,100, then the next level to watch out for would be 25,400. On the other hand, suppose if it were to come down, then I would say that if it starts going below, say, 24,900, then it might test going forward 24,600. Unless that is taken out on the downside, it will be more like a range-bound, someday up, someday down, that kind of a situation. Regarding Bank Nifty, I would say that Bank Nifty, somewhat a similar situation, but slightly weaker. Bank Nifty needs to take out 52,200, 52,400 range. And on the downside, if Banking Nifty were to fall below 51,500, then 51,000 might also be tested. So it's a range-bound scenario, as you said, that more numbers are coming. And on the basis of that, the direction of the market will be found. Generally, looking at the Nifty, it is kind of a consolidation. But if it were to fall below 24,500, then it will become weak.
Okay, all right. Well, 52,400 to 800 are important levels that you're watching out for on the Bank Nifty. That's the word coming from Rajat. Well, let's get in our first query for the day now. We have Joseph, who is joining in on the line from Kerala. He's made investments in Sundaram Finance. Hi, Joseph. Afternoon.
Good afternoon.
Go ahead. You have a question on Sundaram Finance.
Yes, I'm holding 500 shares of Sundaram Finance, holding at an average price of 330.
Okay.
Would you explain me the future prospects of the share, please? Thank you.
Okay. Your average cost, your average acquisition price, if you could repeat it again?
330 per share.
350 per share.
30.
330, 30.
Okay, 330. So you're sitting on a good profit. Excellent profit. And that's what I just wanted to clarify. What is the extent of the profit that you're sitting on? So you want to know what to do with your current profits, whether you should go ahead or, book some profits there. Sharad, let's go over to you. It's a massive gain that Joseph is sitting on when it comes to Sundaram Finance. What would you recommend? Do you recommend, he should probably just stay on and wait for higher levels? Or do you think it's better to probably skim some profits off?
Yeah, I think it's already gone up to nearly 5 times price to book. I think a year or two ago it was trading at 2 times price to book. But though I think the business ramp up has been good, the type of diversification after the merger, that's very much in place. So now the retail book is also a very strong book. It's not largely a vehicle second by a vehicle financing company now. So I think the volatility numbers from here on should be much lesser. The growth rates have been good. The new initiatives the management has taken have worked out very well. But I think at 5 times price to book, maybe I think most of the positives are more than priced in. Though they can continue to improve from here on also. So I think in a staggered way, what you could do is you could try exiting every time it goes higher. Because we are expecting a year-end rally kind of scenario. So maybe over the next 2-3 months, you could gradually exit it whenever you get a price a higher price, whenever the stock goes up by say 5-6%. On that day, you can trim 25-30% of your exposure. Because at these valuations, I don't think in the long term it makes much sense to stay put into.
Okay, so gradually start selling. That's a word coming in there from Sharad. But Rajat, what's your word on the technicals? Are you also concurring with what Sharad is saying? And maybe start selling is the best option for the viewer on a divided basis.
I would say if I were in his shoes, I would start selling if it falls below 4,800. Otherwise, if it doesn't fall below 4,800, then what can happen is that it might once again try to scale up 5,200 to about 5,500 kind of range. But once that goes, definitely you start booking profits, or else if you book profits, first sell at 4,800, then 4,650, and thereafter wait for 4,400. But in a staggered manner, you sell, but at least hold a part of your portfolio, because it is a 17 times kind of, or say maybe 15 times kind of appreciation. So don't sell everything. This is a great company. Even going forward, you will make good money if you continue to hold it.
Okay, surely keeping an eye out on Sundaram Finance, and obviously staggered manner, one could look to sell. That's a word coming in from both our experts. Let's move on to the next query. And Krishnamurthy is writing to us from Coimbatore. He's holding 608 shares of PFC at a price of 277 rupees per share, and 324 shares of RC at a price of 343 rupees per share. So obviously they make a good amount of profit in both these stocks. Wants to know the future prospect of his holdings. Sharad, coming to you, in the last 1 month, at least looking at PFC, quite flat, not much of a move that we're seeing. But let's not forget that both these stocks have seen a very sharp run up in the last 1 year, 2 years when you look at it. So what should one be doing with PFC, RSC? Long term, is it still a good bet?
Yeah, I think in the long term, it would continue to be a good bet. But the period that we are talking about over the last 1.5, 2 years, they were seeing a very strong re-rating. Both PFC and RC were trading at 0.3, 0.4 times price to book. So I think they have normalized over the last 1.5, 2 years. And now they're trading at 1.5, 2 times. And the renewable energy portfolios for both companies should do very well. REC probably is already at a price to book of around 2. PFC probably is comparatively cheaper at 1.6 times price to book. This is all what has been reported. And I think in forward terms also, both these companies should find it very easy to grow 15-20%. And most probably you would not have much of a GNPA hang for both these companies over the next at least 18 to 24 months. And for them to trade at 2 times price to book would not be very difficult. So I think REC is more or less there. Maybe whatever earning accretion happens over the next 12 months, that will add on to the book value and the multiple thereon. But comparatively, I think PFC is a better idea to hold on. But return expectations, yeah, they should be normalized unless and until these companies can prove that they can continue to, latch on to the opportunity of having very high disbursements without any pressure on GNPA and margins. I think that is something most people would want to look into. Now the valuation catch-up story is over. Whether they can get re-rated or not is something that is to be seen. And re-rating is something that does not happen very often in the markets. So it's better that you use the rallies over the next, 3-4 months to exit part of it and maybe diversify into some other stories that you get an opportunity to buy at a later date. But if you're a long-term investor and you're not bothered, you want to stay in for 5 to 10 years, I think then probably they still make sense. But expect annualized returns of 15 to 18%, not the kind of return that they've seen over the last 18 to 24 months.
Okay, Rajat, what about you? What would you recommend on both the twins, PFC, REC?
Regarding PFC, my take is that if it manages to get past, say, 500, then continue to hold it. Because 50-day moving average has not been crossed for quite some time. It is at 492. So that's why I said above 500, continue to hold it. And if it fails to take out 500 or 490 to 500 range, then you should sell. Otherwise, if it were to fall below 440, then also you sell. But at least book some profits because there are some signs of distribution. But you may hold part of it, but do not hold the whole thing because the correction will eventually happen. Regarding REC, it's almost a similar kind of a situation. Here, if it were to fall below 500, then sell. And if it manages to stay above, say, 560, 575 kind of range, then expect further upswing to about 625 or so. But if it were to come to those range, that is 600 to 625, definitely book some profits or else get out of it if it falls below 500 on closing price basis.
Okay, all right, got it. So that's on REC and PFC. That is the trade deficit data, which is coming for the month of September. It's going to come in at a total of around $20 billion. And this exports should come back up for you as well. We'll get back to the data, but nonetheless, that's the September trade deficit data, which is flashing on your screen. 20.78 billion, which compares to around 20 billion on a year-on-year basis. So year-on-year, it's pretty much been the same. And 34.58 billion in terms of exports, and that too has been stable on a year-on-year basis. Well, we now have Poonam, who writes to us from Mumbai. She holds 152 shares of Titan, which she's bought at around 3,000 rupees per share. So she's sitting on a profit on this one. And she's asking, she wants to know what to do, whether she should hold or book her profits. Well, Sharad, let's come to you first on Titan. What would your recommendation be? The earnings are coming out, but from a medium to a longer term perspective, what would you recommend?
Yeah, I think it's been an excellent story over the last few years. Carrot lane kind of businesses could do very well even going ahead. I think they could be the flavor, going ahead because the women workforce in the country is going to go up substantially. And I think the urban landscape should also increase over the next, long term, 2-3 decades continuously. So that should help that part of the earnings, even the lifestyle part of it. Though other than gold, rest of the divisions have not really racked up much of growth over the last few years. They've not become very material to the company. And I think gold and jewelry remain the dominant positioning. And I think even their gold jewelry as such is not getting a lot of traction. And when you are trading at, 70, 75 times 1 year forward and expected growth of sales of around 16, 17% and a bottom line growth of 20, 25%. I think the stock is a tad expensive, though it has corrected a bit from the upper level, 10, 15%. But even then, I think, 70, 75 times is a bit too high on the valuation front 1 year forward. And I think you would get opportunities to buy it at much lower levels. So I think one should try to exit at current prices or maybe gradually, over the next 2-3 months, whenever you get an opportunity or an uptick in the stock. But long-term investment wise, I don't think at these valuations, it makes much sense to stay put in Titan.
Okay, that's the word on Titan. But on that note, we're going to slip into a very short break. Don't go anywhere because we'll be back with more of his stock-related queries on the other side. Welcome back. You're watching Your Stocks on CNBC-TV18 and we have our experts who are solving your queries today, Rajat Bose as well as Sharad Avasthi. Let's keep it going, and the next query that we have is on Nika. Karan is writing to us from Ahmedabad, who's holding 20 shares of Nika at 185 rupees per share, wants to know whether he should continue to hold or maybe look to sell at current levels and switch to something other than this, because they are making slight bit of a profit there, not much there. It's almost near the buy price, so it's quite flattish, but they've at least managed to come back to their buy price. So Rajat, I'm going to come to you. What's your word on Nika? Anything on the technicals that's looking exciting, and can we expect the stock to actually do better and start seeing an uptick now?
It has been correcting since I think mid-August, when it was around 230. And now it has come down to 187. What I see is that around 180, the 200-day exponential moving average is located. And once that is tested, if it were to go below that, then it would be very weak. Currently, all the moving averages, other than 200-day, they are actually giving indications that further fall ahead. Further fall in the sense that 9 and 20 are showing a bearish crossover. Both are coming down, as well as the 50-day moving average, which is also coming down. So it is better that one gets out of it because I really don't see that immediately there would be any kind of major recovery in this stock. On the other hand, it is likely to go further down. So my suggestion is any rally you get out. Otherwise, if it goes below 180, then also exit.
Okay, all right. So that's on the technicals of Nika, which has run up around over 25% in the past 1 year. But what would your recommendation, Sharad, be on Nika in terms of the fundamentals? You know, they've been sort of doing a lot of these partnerships, etc., in the past couple of months as well and quarters. But what's your sense in terms of what your recommendation would be fundamentally, considering that the competition is rising in the space?
Yeah, I think competition is rising, but companies like Nika and Honasa have come in with a different kind of brand positioning that they are positioning themselves. And I think the products are much better than the normal run-of-the-mill FMCG products that are available from the renowned companies as well. So I think that place, both these companies score handsomely above most of the FMCGs. And I think if you look at the next line of management or the people who are to follow up in the footsteps, the type of detailing that they have regarding the products and the profile of the company, I think they have a very clear understanding of what they are here to do. So I think trajectory-wise, these companies should do very well over the next, 10, 15 years. But yeah, valuation-wise, it's a bit of a stretch. I think FY26, you are expected to report 1.5 rupee. Maybe it becomes too good, and what we were expecting, 1.5 year back, maybe 3 rupees. Even then, you are trading at 50, 60 times. So I think the valuation is a bit of a stretch. But if you're a long-term investor who wants to stay in a concept, I think a concept product-wise, they are in an excellent space. The management is very good. And I think even the next level of management has very good clarity regarding what they want to do. So they tick most of the boxes. I think valuation is the only concern. So maybe if you get it, cheaper on any correction, I think that is the time you should lap it up big time. And what you have currently, if it doesn't really bother you much, you can continue to hold and maybe keep an eye on the lower levels where you can add more and stay put for a longer term. Short term, yeah, 1 or 2 years, I think, yeah, you may not be in a very sweet spot to make some money out of it. But long term, the type of tie-ups they are doing and everything else they are doing, I think that's a very good space they can manage. Regarding valuations, if it is traded as, simply as a platform business, then maybe forward they are trading at 6 times EV to sales. Optimistically, they could trade at 8 times EV to sales. So even in the short term, if the markets are good and it's optimistic and the numbers continue to be good, there is a possibility you could see 20 to 30% upside. But generally, I think this is a good idea that you should continue to hold for the long term. You should have an 8 to 10 year horizon. I think these companies could deliver very stellar numbers and have a staggered approach to use the dips, big dips in the markets to accumulate these stocks.
Okay, all right, fair enough. Sharad as well as Rajat, on that note, we're going to wrap up on the show. Thanks very much, as always, in answering all of the queries that we've got. We leave the markets with a little bit of a negative bias at this point in time, just about consolidating. Nifty down around 45 odd points. Closing bell up next.